So you've decided that you want to invest, but you're not really sure where to start. In today's video, I'm going to be talking all things investing. Why you should invest, where you can invest in, what kinds of investments you can put your money towards, and also some of those keywords that can be a little bit confusing to understand. The first question that you might ask is, why should I invest? And again, all personal circumstances are different when it comes to investing. I personally believe that you should be investing in order to become financially stable later in life. Investing gives you so many different opportunities that you're not going to get anywhere else. Before you actually begin investing, I think that it is really important that you actually have a fully funded emergency account or savings. The reason for this is because if something was to happen, let's say that your car breaks down and you need a new car, or that your hot water system breaks and you need a new one, you don't ever want to be withdrawing from your investments if it is not absolutely necessary. This will, unfortunately, if you do this, affect the compound interest of your investment portfolio. The next thing is that if you currently have debts, that's okay. You don't necessarily have to be debt-free in order to invest, because they say that time in the market, not timing the market. Obviously, your first priority should be to become debt-free as quick as possible. So then, with your leftover money or your savings or your extra money from your income can go straight into investing. But no, you do not have to be completely debt-free in order to begin investing. You just need to have a plan. You need to have a plan of when you're going to become debt-free and also when you want to achieve your investing goal. The next thing is that you kind of need to have a reason to invest. Think of it like a really long-term relationship. You need to be 100% committed to your investment portfolio and understand that it's not going to take you 1 or 2 years to become rich, let's say. It's going to take you roughly 7 to 10 or even 15 to 20 years to truly see that outcome. Investing gives you some amazing opportunities. It can give you the opportunity to retire early, to be financially stable. It also has the ability to reduce your workload. So let's say that you were working full time and in 10 years or 15 years time, you would love to be able to work part-time 2 to 3 days a week. If you have planned correctly and thoroughly your investment goal, you will have the ability to actually reduce your workload and have more free time to spend with those that you love and doing things that you enjoy. Let's talk about where to invest your money. So there are a couple things in where you can invest. If you have super and you are in Australia, you are already actually investing your money. Superannuation invests actually in the stock market. That's how you can see those returns. If you look at your statement, you can actually see that you are getting a return every single year or every couple of months and maybe every quarter of your investments, because superannuation, yeah, it is actually an investment. Next places that you can invest in are micro investing platforms and your standard stock market platforms. So micro investing are usually run by apps, and you have the ability to invest just small amounts of money. So a couple of dollars here and there, maybe $10, $50, $100. Whereas the other stock market platforms, that's where you're looking at bigger and broader opportunities to invest larger amounts of money. Say a couple of $100 up to, tens or hundreds of thousands of dollars. The thing to note with micro investing platforms is that they can be quite limited and quite restrictive in what you actually invest in. Rather than those larger stock market platforms, they give you the opportunity to invest in everything in the stock market. Again, with this, each comes with its pros and cons, but please leave me a comment down below if you would like me to make a separate video comparing the differences between micro investing platforms and your regular stock market platforms. So now you're wondering, okay, I know why I want to invest and I know where I want to invest. What can I actually invest in? So in this portion of the video, I'm going to be taking you through the 4 main types of investments that you can choose. They are ETFs, LICs, bonds, and individual stocks. First, let's start with an ETF, which is also known as an exchange-traded fund. An ETF is a collective group or a bundle of companies, shares, and bonds that are invested into the stock market. So you can actually have an ETF that has a couple of hundred or a couple of thousand companies, shares, or bonds. So you might actually choose an ETF that has the top 500 companies in Australia, which means that this investment is actually a well-diversified portfolio because there is less risk of losing all of your money with this particular ETF. Let's say, for example, that you choose the S&P 500, which means that it has a collective group of 500 companies or bonds and shares. And let's say that one of them isn't doing very well and they drop down to 501. You then will have another company that replaces that company, so then there isn't so much fluctuation within that ETF. You're always investing in the top performing 500 companies in Australia. So if one of them isn't doing really well in that quarter or year, I'm not really sure when, it kind of depends, but when it drops out, one then replaces it. So you're always getting the best performing companies for your investment. Now we're going to talk about a LIC, or a listed investment company. These are very similar to ETFs as they are very well diversified. They are a type of investment product that has been incorporated as a company and listed on a stock exchange. That company will then invest in other companies, typically listed on the stock market. A LIC will have an external and internal management team who is responsible for choosing the company's investments and managing them. Keep in mind though that if you are investing in a LIC or a listed investment company, sometimes these management fees can be quite high, and so it may not be the best choice for you. However though, having a well-diversified investment portfolio is what we all are about on this channel. So having different parts of different kinds of investment, whether they be LICs, ETFs, stocks or bonds, we do encourage you to have all these different kinds of products in your investment portfolio to ensure minimum risk. An example of a LIC that you can invest in is called a FI. Let's talk about a bond. So a bond is essentially an IOU between an investor and a borrower. If a government needs to raise money for a certain project, they will look to investors for an IOU with a guarantee of an interest return. You are essentially loaning the money with the promise that you will be getting a return plus interest on top of that return. So let's say, for example, that you lend or you invest $100,000 into the Victorian government project and they promise you to give you a 20% return on your investment. That means that you can expect to have your $100,000 back plus that $20,000 on top of your 100. However, you do need to keep in mind though that bonds technically, or sometimes they don't really get a return until at least 10 years later. But hey, if you're investing in something, you are expected to be in it for the long haul regardless anyway. Individual stocks. When you buy an individual stock, all that money that you have invested in is only invested into that one company. You may become a part owner and it will most likely be a very small percentage. The thing to consider when buying an individual stock is that it has a higher risk portfolio, which means that because you are only investing in one company, and if that one company was to fail or if they were not performing as well as you had hoped, it means that you have a higher risk of not getting a good return on your investment. It also means that if that company was to potentially go bust or to go broke, you also have the potential to lose all of your money as well. You should never put all of your eggs in one basket. Like I just said, we really encourage you to have a variety of different investments in your portfolio to again reduce that risk of losing money. So some words that you may have heard me talk about and you're thinking, what do they mean? I've got no idea. Let's start with the first one, which is diversification or diversified. Diversification aims to reduce risk by investing in a wide variety of investments within a portfolio. For example, having just one investment is not classified as a well-diversified portfolio. This being because you only have your eggs in one particular basket, if things are not going well, it means that you potentially have a higher risk of losing money. However, having multiple investments in different LICs and ETFs means that you actually have a better diversified portfolio because each of these ETFs and LICs, they target different sections in the stock market. You're not just targeting one particular sector in the stock market, you're looking at all different ones. And keep in mind that different sectors within the stock market perform differently. Some will get a higher return than others, and it also fluctuates depend on day, time of year, and also what other countries are doing as well. So for myself personally, I will never invest in just one particular stock or on one particular platform. I really hope to have a really well diversified account. I might buy an individual stock maybe, but I'll also make sure that I have a variety of different ETFs and LICs to support if that one investment does not do well. So the next one I'm going to talk about is called a brokerage fee, and I haven't actually spoken about this just yet, but a brokerage fee is a fee that is charged to handle transactions, whether that be for buying or selling any sort of investment. So every time you want to purchase, like let's say 50 units of a particular ETF, you are going to have to pay a broker to finalize that payment. In Australia, our brokerage fees are usually around $9 to $10, depending on the investment platform that you're going with. Micro investment platforms, their fees are significantly lower. Some don't have any until you reach, I think it's $5,000, and then it's 0.005% after that. I know Raise, please correct me if I'm wrong, is $2 per transaction, and then ComSec, I believe, is around $9.50. And I know that Self-Wealth is $9.50, no matter how much you actually invest. So if you are investing in Self-Wealth and you want to invest $10,000 or you want to invest $1,000, the brokerage fee is actually going to be the same, which I think is so good. I think that's so fantastic because it means that you're saving money. Myself personally, I use Self-Wealth just because it is a flat fee for the brokerage and I know exactly how much I'm going to be paying. I, however, build up to a certain amount before I begin to invest. So I was originally doing $500, but then that's way more expensive than saving up to $1,500 or $2,000, because then the brokerage fee kind of evens out and it doesn't seem like such a blow when I do my investments. So some things that I want you to take away from this video is that you actually need to plan out your investment journey. You need to have a clear understanding of where you are heading and what you want to invest in. You need to set yourself some goals, your end goal, or it could even be a monthly goal. What do you actually want to achieve? Why are you investing? You also need to make sure that you are doing your own due diligence. Don't just listen to Uncle Roger at the barbecue on a Sunday and he tells you what you need to be investing in. You actually need to be reading up and looking at things yourself, not just taking your word from anyone. You need to make sure that you are confident and comfortable in every single investment that you make. I mentioned this at the start of the video, and I am a huge believer of having an emergency fund before you begin, because like I said, if something was to happen, you don't ever want to be taking out your investments before you need to. The reason for this as well is that you have the potential to pay capital gains tax, which is a tax that you pay if you make a profit on investment. So if you have to withdraw your investment for whatever reason, when it comes to tax time, you'll actually have to pay that capital gains tax when you withdraw any sort of money from your investments, which could essentially put you in a worse financial position. And lastly, you gotta be committed. Think of investing like a long-term relationship. And if you've never been in a long-term relationship, well, welcome to one. So investing, really, you have to be in it for the long haul. They say that you don't usually see a good return until 7 to 10 years later. So if you are not ready, for that commitment, start somewhere else. Start with micro investing. Start with building up your emergency fund. And then once you feel like you are bold enough and more comfortable with being in that relationship, then you can start investing. Alright guys, I really do hope that you did enjoy today's video. Please make sure that you give this video a big thumbs up so then I can get this information out to other people in the YouTube universe, so then we can all enjoy this investment journey together. Thank you so much for watching, and I will see you in a video sometime in the very near future. Bye!